All right, so we left off talking about management assertions. I want to finish up talking about that today. And we covered, remember, there are 3 categories of management assertions. So if you look in the textbook, chapter 1, you'll see that there are management assertions that are PCAOB assertions versus ASB assertions. And the management assertions are the same across, whether it's PCAOB or ASB. The only difference between the two is that the ASB breaks out the assertions in more detail. So they break out the assertions in terms of categories of assertions, whereas the PCAOB doesn't. They just lump them all together. So for our purposes, for this class, I want you to concentrate on the ASB assertions in the way that the ASB presents the assertions, which is by category. And so we talked about 3 categories of assertions, one being assertions dealing with transactions and events. And so those are really the assertions that management's making with respect to the economic transactions that the company engaged in, right? And that's really what is going to flow through your income statement, sales, expenses, right? So those are the things that flow through the income statement. And then there are assertions about account balances, which management makes assertions that, yes, I have cash of $10 million, or I have accounts receivable of $5 million, right? They're making assertions that the amounts recorded in the balance sheet are true or valid, right? So those are assertions about account balances. And then the final category is the category of assertions about presentation and disclosure, right? And so that is exactly what it suggests, that it's assertions about, yes, we recorded all current liabilities are truly current liabilities, right? Or all current liabilities represent obligations that the company is obligated to pay within a year, right? So that's about the presentation. That everything that's included in the balance sheet represents assets, liabilities, and owner's equity. Items that are flowing through the income statement pertain to the company's operations. And then disclosures, obviously the footnote disclosure, assertions about the footnote disclosures that accompany the financial statement. So those are the 3 categories of assertions. So we left off talking about management assertions about classes of transactions on Friday. That's where we ended. And the takeaway here is, if you look at it, we have the assertions that management makes. Auditors, the audit is developed, or the audit approach is developed around this framework of assertions. So that's what we mean here about general transaction related audit objective. What's the audit objective related to occurrence? Well, obviously auditors want to ensure that recorded transactions exist. So they're going to design their audit procedures to determine that the recorded transactions, those amounts that are reflected in the sales journal, actually exist. They represent valid transactions. They did occur. So for example, what the auditor is concerned with when they're testing the occurrence or gathering evidence related to occurrence is that sales are not overstated, right? They're concerned about overstatement of sales. So they want to make sure that they do exist. So they're going to design audit procedures to test that recorded sales are for shipments made to non-fictitious customers. And the reason that we use shipments, right, as a proxy, right, that's a good indication that the sale occurred, right? Because under GAAP, that is one thing we look for. We look to see that the shipment, that the sale is earned, that there's been this arm's length transaction. And one way to determine that is, did we ship the goods? So if you think back to your financial accounting, one of the things that you would look for to determine that the sale is a valid sale and should be recorded in the current period, right, is that they actually ship the goods, right? FOB, shipping point, right? So the ownership of the goods transfers to the customer when it's shipped. So that's why shipping, right, is a good indication that the sale actually occurred. So the auditor is going to look for evidence that the shipment occurred. Right. So that's occurrence. And then completeness is, they're worried about understatement, right? Because they want to make sure in this case, the management is asserting that all transactions that should be recorded have been recorded. So the auditor's objective is to make sure that all sales that have occurred are included in the sales journal. So a completeness is concerned about understatement. So now the auditor is going to gather evidence to ensure that for all of those shipments that were made, that the client has actually recorded the sales in the sales journal. Right. So make sure you understand the distinction between occurrence and completeness. Occurrence, the auditor's concern is overstatement. Completeness, the auditor's concern is understatement. Right. And then, so we'll go through more examples of these. And then we finished off talking about accuracy. And with accuracy, the auditor is concerned, actually, obviously, that the transaction is recorded at the accurate amounts and that they've been posted to the correct account. So you want to make sure that sales to customers don't include sales to related parties, right? Because related parties should not be included in your sales. And then classification, if they're properly classified, and cutoff, the auditor is concerned with timing. So they're concerned with whether or not the sale actually occurred in the reporting period. So if the client's fiscal or the client's year end is 12/31, the auditor wants to look for evidence that all sales that should be recorded as of 12/31 have been recorded in the correct period. Right, so that is, these are the assertions related to transactions, using sales as an example. The key point here is that it doesn't matter what cycle you're looking at. So even if you're looking at the acquisition cycle, if you're looking at the inventory cycle, your transactions and events, the assertions you make are the exact same assertions. Management is making the same assertions about transactions and events across all cycles. The difference is the auditor's objectives will change, or the audit procedures will change, right? So if we're talking about acquisitions, for example, the auditor is still going to be concerned whether or not that acquisition actually occurred, right? So they're going to look for evidence to ensure that the transactions that have been recorded in the financial statements or in the income statement actually occurred. The audit evidence they collect will be different, right? So obviously they're not going to look at shipping documents to determine if it occurred. They're going to look, for example, at receiving documents, right? Because the receipt, if we accept as a customer, if our client accepts the goods in their warehouse, there's evidence that they are obligated to pay for it, right? So it's a valid transaction. So it's just your audit evidence that changed. Management assertions are the same across all cycles.